Welcome to the next of our series of Express videos related to the paper Foundations in Audit within the ACCA's FIA qualification. Just to remind you, these videos are all based on Express notes, which you can download from the website www.theexpgroup.com. Currently, we are within chapter 2 of these notes, and we will now move to page 18 to discuss the audit risk model. In the previous video, we discussed audit materiality, and I said it was a fundamental concept. Similarly, risk is the fundamental audit concept. From what you already know, auditors provide assurance. This assurance is reasonable assurance that the financial statements are free from material misstatement. So from that you can see that the auditors cannot and are not expected to detect every single error, every single misstatement that might appear in the financial statements. That is because they are forced to do everything on test basis. So they will need to design tests, they will need to design procedures in order to detect all material misstatements. As you can imagine, chances are, or the risk is, that they will not be able to detect all material misstatements. This is the auditor's risk. This is the audit risk. Specifically, audit risk refers to the problem that the auditor will issue a wrong opinion. So if they do not detect all material misstatements, they will issue clean opinion when there are material misstatements, or sometimes there may be the case of acting the other way around. Based on the selection of their samples, accidentally they came into all the misstatements that happened in the company. And then they extrapolated it from the sample to the whole population, and it turned out for them that there is a lot of misstatements, which in fact wasn't true because the rest of the population from outside the sample was free from misstatements. So it may also happen that they will issue a qualified opinion when clean opinion should be issued. That is the risk. That risk needs to be managed by the auditor. The fundamental risk model is presented on page 18 of the Express notes. The risk model says that audit risk, the risk of issuing a wrong opinion, is a product of inherent risk, control risk, and detection risk. First, let's talk about the inherent risk. Inherent risk is the risk that there may be material errors just by the nature of the company's operations. It's inherent, it's within the company, it's within the substance of transactions that they do. To illustrate it, if you see a lot of manual operations, a client with manual accounting, the inherent risk will be higher. Because when manual operations are done in accounting, there is always a risk of getting it wrong, of posting a debit and forgetting about credit. When these operations are automated, now this shouldn't happen. The IT systems prevent people from posting debits without credits. So in automated systems, inherent risk is lower. Similarly, if you look at the bank, there's a huge number of transactions, but they're all automated. Plus, banks are regulated. They're subject to strict supervision, and therefore inherent risk is low. But when you see a business with a lot of cash revenues, which cannot be objectively verified, and there is a high risk that some of those transactions are not properly recorded, inherent risk goes up. So inherent risk is just the risk embedded within the operations of the company, the risk that transactions may be proceeded in the wrong way through the accounting, which will end up with a material misstatement. Now, inherent risk can be managed by the company by introducing a tight system of internal controls. So even if you have manual accounting, but you have a multi-level review process, so there is a bookkeeper who posts invoices manually, but then there's a chief accountant that checks every single invoice, how it was posted. Even though there's a high inherent risk in this process, the internal control should detect debits posted without credits. Control risk, therefore, is the risk that client's internal control will not detect errors generated as a result of inherent risk. So if you have manual accounting, but very tight controls, you will have high inherent risk with very low control risk. However, if you have manual accounting, inherent risk will be high. And then if you have just one bookkeeper in the company with no supervision, then control risk will also be high, because there is a high chance that due to the lack of supervision, mistakes made in accounting will not be detected by the system of internal controls. These two risks, inherent risk and control risk, relate to the audited company. The auditor cannot do very much about it. They are what they are. The third risk is the detection risk. It is the risk that material misstatements will not be detected by auditors' procedures. So obviously, if there is a high inherent risk and high control risk, the auditor, to audit that company, has to design procedures that are detailed enough that are robust enough to detect all the errors that may have been generated due to high inherent and control risks. So basically, the higher inherent control risk, the more procedures the auditor needs to do. If inherent risk is low and control risk is low because there is a very tight and effective system of internal controls, then auditors' samples and auditors' procedures do not have to be so comprehensive, and samples do not have to be that big, because the chance of getting things wrong will be very small. Now, on the practical side, if you look at the application of it, on this model, the auditor sets this level sets the audit risk at some percentage that is acceptable to that auditor. Let's say 2%. The auditor wants a 2% risk, accepts 2% risk that they might issue a wrong opinion. Then they put some numbers here. They say the inherent risk is X% and the control risk is X%, and this is the outcome, the product. In fact, it's the detection risk that is the unknown, and whatever comes out of this calculation, we want to maintain 2% audit risk. How to do it, given the fact that we have X% inherent risk and X% control risk? We need to have a detection risk of something. And when we know what sort of percentage detection risk we can allow ourselves for, then we know what procedures need to be designed, how comprehensive they should be, and how large the sample sizes should be. That's all part of audit methodology that each firm should have. The detection risk in general can be of two types. The first one is easier to manage. It's the sampling risk that can be managed statistically. That is, basically, we did not detect a material misstatement because our sample was designed wrongly. It was not designed in such a way that the errorness factor was included in the sample. Right, as I said, this can be managed statistically. The one that is more difficult to manage is non-sampling risk. So, for example, we did not detect a material misstatement because the staff that we sent to the project were not competent in the client's business and they did not detect the risk. Or the staff were too tired, too overworked to focus on certain areas. These are all non-sampling risks, which also need to be taken into account by the firm.